So how does capital gains tax work in the UK? In this short video, I'm going to tell you everything you need to know as a property investor about capital gains tax, how it works. But before we do kick things off, always make sure you're hitting that like button, giving this video a big thumbs up because it is pure tax saving bliss. And also make sure you hit subscribe with notifications turned on so you get notified as soon as we post videos 3 times a week. So capital gains tax, do you know what it is? Let me know in the comments. Are you a property investor? You haven't got a clue about capital gains? You won't be alone. And this video is going to educate you and help you become a better and more profitable property investor. So yeah, let me know in the comments, guys. Do you know about capital gains? Heard about it before? Paid it before? What's your experience? Talk to me. So capital gains tax, what is it? Well, it's basically the way of taxing capital gains, fundamentally. Capital gains tax. This video, we're going to be focusing on a residential property and how it works around that. Capital gains tax does also apply on commercial property, sales of shares and other assets that are within the scope of capital gains tax. But for this video, we are literally focusing on residential property. So where you sell a property, say for instance, we'll keep the numbers simple, you sell a property for £200,000, that cost you £100,000, you've made there £100,000 capital gain. Basically, where you make a profit on a capital asset, it's going to usually be subject to capital gains tax. There are various different expenses you can reclaim as well, basically offset against your capital gains tax amount, the amount that's chargeable to capital gains tax. So here, if you were that £100,000 profit you've got, when you deduct your stamp duty that you paid when purchasing the property, your solicitors' fees, surveying fees when acquiring the property, and also any capital improvements that are still reflected in the asset at the time you come to sell it, you can deduct the cost of those as well. So if you put an extension on the back that cost you £25,000, you can claim tax relief on this as long as that extension is still there when you sell the property. And the aim here is to try and put as many expenses through, so make sure you are keeping good quality records of all of your capital expenses so that when you come to sell the property in 10, 20 years' time, you've got these good records, and as a result your capital gains bill is going to be as small as possible. So that's not it. Essentially each individual also has a capital gains annual exempt amount, and it works in a similar way to your personal allowance in that it's a certain amount you can receive each year tax-free without triggering a capital gain. So for this year, the tax year 2021-22, it's actually £12,300, and this is the total amount of gains which are free from capital gains tax. So if you have a chargeable gain that falls within that £12,300, there's no tax to pay. And if you had to say £100,000 gain, capital gain, that £12,300 would come off of that, and then you'd only pay tax on the rest. So what rates of tax do property investors pay for capital gains tax? Well, there are 2 main rates. So you've got 18% and 28%. You'll pay 18% on a capital gain where it falls within your basic rate band. Anything over and above this, it's 28%. So it is quite a lot of money when it comes to actually the tax side of it. And unfortunately, if you're a higher rate taxpayer, there's usually not too much that can be done to actually avoid the capital gains tax side of things. Of course, it doesn't always apply. So there are some exemptions from capital gains tax, especially when it comes to residential property. The biggest one that's worth mentioning is your primary residence relief. So where you occupied a property as your main residence, essentially, the period of occupation that relates to this, basically where it's your main residence, is exempt for capital gains tax, and also the last 9 months is as well. And what this means is where you've lived in a property, say for instance you basically had it for 10 years, you lived in it about 5 years, basically just over that 5 or 6 years are going to be covered by your PPR plus the 9-month rule, and as a result you only pay capital gains tax on that 4 years worth of ownership where it's been let out, because the rest will be covered by PPR. So that's a fantastic exemption to be aware of to make sure that you are claiming this and you're not just paying tax over and above what you possibly could be. So when do you need to report a capital gain? Well, the rules used to be all residential property disposals, you need to do a return within 30 days of selling the property. On the winter budget, the autumn budget, they actually changed this now, so it's now 60 days. So when you sell a property, you've got 60 days to let HMRC know and file the CGT return which is basically where you calculate the preliminary amount of tax due. And then when you do your self-assessment as well, if you were a higher rate taxpayer or a lower rate taxpayer and the figures moved around, then might be more or less tax to pay when it comes to doing your self-assessment tax return. But that's the main thing. Make sure that you are aware you need to do a return within 60 days. This is where there's tax due. If you sold your main residence and there's no actual capital gains tax to pay, you do not need to file a return. That is fine. So watch out though if you are looking to transfer properties from your own name to your limited company, because what a lot of people don't realise is that this takes place at market value for capital gains purposes. So where you transfer the properties from your own name to your limited company, it's deemed to be a connected party transaction, and as a result, capital gains tax applies as if it's a market value disposal. So what this means, you might be moving your properties from your own name to your limited company. You're not actually going to get any cash for this because your company doesn't have the cash to give you. It's simply just, you basically buy them off them. You're hoping that you can do it at a £1 or a low market rate. But what's actually going to happen is it's all deemed at market value, so you will have the capital gains tax bill personally to pay in your own name, which could be up to 28%, as we mentioned earlier. So this is definitely a pitfall, and quite a lot of people do often overlook this. They need to know that, well, you need to remember that it's a market value rule that applies here, so don't just rush into this kind of tax planning because it may well cost you a lot of money in the long run. A question I also often get asked is, how do limited companies pay capital gains tax? And this one's relatively straightforward in that capital gains tax doesn't necessarily apply to limited companies, but basically limited companies do pay corporation tax on their capital gains. So if a limited company were to sell a property and had a £100,000 gain, of course we're trying to deduct all of the necessary expenditure, the stamp duty it paid, legal fees, surveyors fees, all of that kind of capital expenditure. And then the net gain that we're left with, the actual chargeable gain, would be subject to corporation tax. Currently 19%, it could be 25% depending on when you make the gain in the future after April 2023. So that's definitely something to bear in mind, is that capital gains for a limited company are all basically washed in and taxed at the normal rate of capital gains tax. So that's it really, that's the quick 101 of capital gains tax as it applies to property investors. It's certainly some of the key fundamental knowledge covered in this video. I really hope you've enjoyed it. If you do, make sure you are dropping in the comments that you've enjoyed this video. Did you learn anything from it? Do you think it's a pile of garbage? Let me know, I would love to hear from you guys. Drop something in the comments, give me a thumbs up, and make sure you subscribe with notifications turned on. Bye for now.